Hey, welcome to Unbridled Wealth. Whether or not you've been able to join us for one of our full Banking Reimagined presentations, I just wanted to give you a quick, 20-minute snippet and condensed version of what we mean by Banking Reimagined. So we're going to start with getting into the basics of it, because you may not actually know what Banking Reimagined means. So when we say Banking Reimagined, we're saying it's similar to, the infinite banking concept or privatized banking, which is where we use whole life insurance as a vehicle for your private banking strategy. So the biggest question I'm asked, why whole life insurance? Because let's be honest, there's a stigma around it and we understand that. But there's three main reasons why we use whole life insurance. The first one is it's the only thing we get guaranteed gains plus dividends on top of it. As well as that, those gains have great tax advantages to them. And finally, we get access to the money the whole time. So hey, if you know another vehicle that can give us all three of those things, then shoot me an email and let me know. But I wanted to start with the basics of what I believe is the most important part of this strategy, and that's policy design. So let's start right here. So if you're familiar with whole life insurance, you know there's a premium, there's cash value, which I call CV, and there's a death benefit. So it's still a life insurance contract. But the way that we design this policy makes all the difference in the world. So there's two things that make up your your premium, and that's your base premium. And then there's something called PUAs, paid up additions. So the paid up additions, think of that as the part of your premium that most affects your cash value. Yes, it does still buy death benefit and life insurance, but it pretty much goes straight to your cash value. And then there's your base premium. So think about that as the part of your premium that most affects your death benefit. So the larger the base premium, the larger the death benefit. So if we're talking about a whole life policy that's designed for Banking Reimagined or the infinite banking concept, we want a high paid up additions and a low base premium. And I'm not going to get into it on this video, it's a condensed version, but I'll just tell you we usually design it with about 25% in base and about 75% in paid up additions. What that means is, even in your first year, if you pay, let's use easy numbers, if you pay $10,000 into your premium, so 7,500 in your paid up additions, 2,500 in your base, you're going to have about 7,500, 7.5K in cash value. So cash value, let's talk about what that is. This is the portion of the policy that you have accessible to you. Think of it like a line of credit against your death benefit. So let's say your death benefit here is, let's just say $500,000. The 7,500 is the portion of your death benefit that is available for you to use. So what do we use that for? It could be your emergency fund, your savings account. We use it for investments. It's an and asset, right? So we're actually going to use this money and go and invest in real estate and small business. And then finally, it's for debt repayment or debt pay down. Let's say you got a student loan. If you build up your cash value, you could even pay off your entire student loan and now pay yourself back. Hence, you become the banking system. Okay, so the first year you've paid in $10,000, you got $7,500 in cash value. Let's say next year, here's the beautiful thing about designing a whole life policy this way. Because the paid up additions are flexible premiums, you can pay them in, you can pay part of them, you can pay nothing at all. So in year two, you have to pay in the base, $2,500. You can pay in up to a maximum of that $10,000. So let's just say that this year you pay in the $10,000. Your cash value in year two, and this does depend on your health, your age, your gender, but it's going to go up by approximately that $10,000 in the way that we design the policies. So let's say year two is up to $17,500. So what that tells us is your cost of insurance was actually overcome by the gains inside the policy. Why does that happen? Because your cash value here receives a contract rate of 4%. That is your guaranteed rate. It has paid out every year for more than 150 years, but on top of that, you receive an annual dividend. So if we look at this last year, it was 5%. If we look at the average with our primary carrier, it's been almost 7% for the last 10 years as the average. I think it's actually about 6.9%. So for today's exercise, we're in a low interest rate environment. We're going to stick in that 4 to 5% range as a pretty conservative estimate of where things are at today. So let's skip all the way forward to year 10 because I want to show you the mechanics of how it actually works before we jump into a case study. So let's say in year 10, you paid in the full $10,000 each year. Your cash value is going to sit somewhere around, so 100,000 in, around 110,000. We're going to be about 10% above what we've paid in, which again, we're not saying that's a really exciting return, but hey, you've got now this death benefit, and you've got this cash value which is growing every year, guaranteed for the rest of your life, and yet you still have access to it. So what do we do with this 110,000? Like I mentioned, debt pay down is for investments. It could be your emergency fund. So let's take investments because that's what we all want to talk about, right? How do you make money with this money? You got $110,000 and you say, hey, Jonathan, I'd like to use that money and go buy a rental property. I'd like a $100,000 loan. Okay, so no, I said loan, not withdrawal. If you had a traditional bank account and you go take out $100,000, your bank account decreases in value, right? With whole life insurance, it works a little different. So you take out a $100,000 loan, and you're going to pay interest on any of that money you've borrowed because it's a true loan. But what happens at the same time is this $100,000 continues to earn the interest and the dividends on top of it. So I'll give you some quick numbers. Again, condensed version, I know the math. If you took out a $100,000 loan, you used it as an investment in a rental property, used it to grow your small business, and you decided, hey, I'm going to pay myself back on a 10-year note, your interest is going to be 5%. So if you pay yourself back over 10 years, consistent payment, it's about $1,000 a month, you'll pay a total of $27,000 in interest. And if you're not a numbers person and you're having a hard time following me, just stay with me for a minute and I'll recap. Over that 10 years, there's going to be a $27,000 approximately expense. So the question is, why would you pay interest on your own money? It makes no sense. Here's why. Over that same period of time, this $110,000 continues to grow. So again, I'm going to give you ballparks, non-specific numbers. We can run these based on your age, your health, if you meet with us, but let's just give you some generic numbers. Over the next 10 years in this policy, it's actually going to grow by about $65,000. And that's just at the current rates. That's not the max it could grow by. It's also not the minimum, but it's going to grow by about $65,000. So let me ask you a question. If you had $100,000 in the bank, and I said to you, hey, you can take the $100,000 and go use it for whatever you want as an investment, and you earn no interest. Or you can take the $100,000, you got to pay me $27,000, but I'll add $65,000 to your bank account. Would you do it? I'm assuming the answer would be yes. So that's the basics of how the infinite banking concept works, or using whole life insurance as your banking strategy. So let's jump into a quick case study. We wanted to start with a case study of a real example of somebody that is a client of ours. So this is Jordan. This is Father Stan in the photo. He obviously gave us permission to share his story. So I think one of the unique things about Unbridled Wealth is we're not just selling life insurance. We want to come alongside you, be an advocate, be an advisor for you, and really help you make decisions financially. So this was Jordan's situation. He came in, he was earning $46,000 a year. He owned a $200,000 townhome, had $8,000 in credit card debt, a large truck payment, and some student loans. So Jordan came in basically with the idea of, hey, I need some help. And so we said, Jordan, what's your financial goals? He said, I want to have $1 million in my 50s. So in this case, again, a little different to what we usually do, but we said, okay, if this is your goal, $1 million in your 50s, what do we need to do today to back into that goal? And we said, okay, you would have to put $20,000 a year into a policy like this for 20 years. So usually, back to the base and the PUAs. The paid up additions portion, we typically do this for about 5 years or maybe 10. In this case, we did it for 20. So we said, if you do this, we know you're consistent with it, you'll have $1 million of cash value in your 50s. So the big question is, he makes 46 grand. How on earth is he going to be able to afford $20,000 a year in premium? So we know there's two ways to do this. Increase your income, decrease your expenses. So what do we recommend? We said, Jordan, you've got a 2-bedroom townhome. It's just you living there. So get a roommate, which he did, $800 a month. That was actually about half of the premium needed. The other thing was, for his work, he traveled, and so he would fly to his 3-state territory. We said, Jordan, if you drove instead of flew, you can charge mileage, you'll save money, and you'll make some money. Finally, we took a cash value loan. So remember I said this cash is accessible to you. So in his case, when he paid in $20,000 that first year, he had about $14,000 available, took out a loan, paid off his credit card, which he was paying 23% in interest, and now he's just got this 5% interest to himself or to the carrier, as well as his policy still earning money. Finally, he traded in his truck and he got a car, and that saved him about $140 a month in gas. So add up all those things and we're at the $20,000. So let's take a look at his numbers. Obviously, Jordan is young, he's in good health, but you can see in the bottom left, when he put in $20,000, he had $14,000 in cash value even that first year, and that created an almost $1 million death benefit. And so if you follow these lines across, so in orange, we've got the premium he's paid in. In purple, you can see the cash value and how it grows. And then that top line is the death benefit. So I'm going to skip all the way out to age 44. So if you can track with me, you can see there's $400,000 paid in premium, and there's $619,000 in cash value. Again, this is just on the non-guaranteed or the current scale, which is actually below the historic average. So it could be more than that, it could be less than that, but we're going to go with that as the average for today. So he's got $620,000 in cash value and $2.6 million in death benefit. But what was Jordan's goal? $1 million in his 50s. So let's skip now to age 54. So over that 10-year period, instead of paying in $20,000 a year from age 44 to 54, he's paying in just around $6,000 a year or $500 a month. But how much does this policy grow? It grew from $619,000 to over $1.1 million in cash value. So goal accomplished, and his death benefit's about $3 million. So when we asked Jordan why was the goal $1 million in his 50s, it was for one reason. He wanted to know that he was going to be okay in retirement. And for you, you may not have a retirement plan. Maybe you've got a great one, but maybe it's about leaving money behind as a legacy for your kids. So let's skip forward again to age 69. On the right-hand side, he's paid in a total of $532,000 in premium over the life of this policy. He's got about a $2.5 million cash value and a $4.2 million death benefit. So we said, Jordan, if you just look at this one policy, and this is assuming he never got a raise, right? So there's no other money. It's assuming that he didn't take out the money and use it for investments, for paying down debts, which he's actually already doing. But you can see his cash value grew from age 69 to 70, from 2.47 to 2.6 million. That's $130,000. So what could he do with that? In his retirement, what if he took loans out of $100,000 a year and used that to supplement his retirement income, knowing that when he passes away, the death benefit would repay any outstanding loan, and his kids or beneficiaries would get the rest of the death benefit available to them, which if at age 70 it's $4.3 million, who knows what it's going to be at age 85, 90. So here at Unbridled Wealth, we want to help you with strategies like this. So this may not be your exact example, but we want to individualize every strategy that we create. Because we say that in this world, there's 3 types of people. There's the debtor. So I would say this is one of the most prevalent types of people in our society today. It's those who they can't afford it, so they put it on credit card, they finance it, they're going to pay it down and get down to zero. So that's really common what we're going to see, is people are going into debt and trying to get back to zero. Then there's the saver. They're the people that are like, hey, if I can't afford it, I'm not going to buy it. So I'm going to build up my money in my savings account. I'm going to wait till I have enough. I'm going to stroke one check and buy the thing that I've wanted. Maybe it's a couch, maybe it's a TV, maybe it's a car. So those are the savers, but they also usually end up at zero before they start rebuilding again. And then finally, there's a wealth creator. We want to create and help wealth creators. So the wealth creators know that, okay, in an investment, you often lose access to some money today for the sake of benefit long-term down the road. It's called delayed gratification. So let's say you buy a rental property today for $100,000. You know that if you turned around and sold it tomorrow, you're going to lose 6% because of the realtor fees. So you had a loss of access. You also had a down payment, which you lose access to. Then 30 years, the house is paid off, you got rental income, and hopefully the property has gained in value. So that's our wealth creators. And we say these three types of people live in three lands: the land of not enough, just enough, and more than enough. So obviously our goal is to get you from whichever land you're in today to the land of more than enough. And if you're in the land of more than enough today, let's talk about legacy. What's the financial legacy you want to leave behind for your kids, for your grandkids, and their children? All right, I'm going to give you one final example, okay? It's the real estate one. So most people that I talk to, they're like, hey, I'll say, what's your investment strategy? What do you want to do? They're like, hey, I want to own rental properties and live off the passive income, right? Sounds pretty great. So let's just do an example of if you do it the traditional way. You got your bank account at Wells Fargo versus what if you did it using the system we're talking about where you're using your cash value to go and invest in properties. So let's talk about this hypothetical world. You've got this beautiful house, it's $200,000, so it's probably not here in Denver, Colorado. It receives $2,000 a month in rental income, $1,000 or $100 a month in insurance, etc. You can see the rest of the expenses. So I'm saying there's unlimited of these houses that you can buy at any time for exactly $200,000. So traditional route is you put 20% down, you finance the 80% with a bank. And I just wanted to do an apples to apples comparison of whether you're using a traditional bank account or the infinite banking concept, Banking Reimagined. So in option A, you've got $200,000. You can go and buy 5 of these houses because you're doing 20% down. What's that going to look like? And then option B is the whole life strategy. So $200,000 in cash value, you're doing the exact same thing, buying the same 5 houses. So let's look at option A. Year 1, your gross revenue is $120,000. If you're in a 30% tax bracket, which is perfectly reasonable, your net profit is going to be $40,000 after expenses, and so your post-tax profit is $28,000. So 10 years down the road, hey, you've made $280,000 post-tax, plus your house equity has gone up if the houses increase in value. It's a fantastic investment. Would never criticize you for doing that. But let's just see if we can turbocharge it using the Banking Reimagined strategy. So option B, same thing, same revenue. The net profit is actually going to go down. Why is that? We're actually suggesting that you make repayments to yourself from the loan that you took from your whole life policy. So if you see on the left-hand side, there's a monthly repayment back to your policy. So your net profit has gone down. What does that mean? Less taxes. But at the same time, your cash value is growing. So even in that first year, instead of having a post-tax profit of $28,000, you got a post-tax profit of $32,000. What I mean by that is, you've got the gains inside of your cash value as well as the cash that you're receiving after all of your expenses are paid. So that's a beautiful thing. You look 10 years in, you've actually got about $365,000 instead of the $280,000 with the traditional strategy. Hey, just to be clear, this is assuming it's a policy that has reached year 10 that we're doing this strategy with. We can run the numbers for you early on. You don't have to wait 10 years to get started, but this is just an easy, clean way to do an apples to apples comparison. So again, this is just going to show you the side by side. Year 10, would you rather $280,000 in post-tax profit, or would you rather $365,000? I think the answer is pretty obvious. Okay, we're going to go with one last case study. And these are for nonprofits, churches, anybody in the nonprofit sector. So the reason I've added this one is there's actually a really incredible way that we can use whole life policies for not-for-profit organizations. Because we're not worried about the taxation, we can do what's called a MEC, a Modified Endowment Contract. So typically we're designing these policies with a ratio like this in order to avoid it being a MEC. The reason being, if you have a MEC, then you owe taxes anytime you borrow money above what you've paid into the policy so far. With a church, with a nonprofit, that doesn't matter. So here's an example of what if you had a pastor who's in their 40s and you're like, hey, we want to pay him a retirement income because he's given his whole life for the church. He's probably worked way more than 40 hours a week. So can we pay him even after he is retired? With one caveat, we want the church to recoup all of the money it pays out in his retirement income. So that's what was posed to me. So here's an example of that very thing. It's a 43-year-old male pastor in Texas. In the church, what they did was a ratio that's a little bit different. It was about 20% on the base and 80% on the paid up additions. So for 10 years, they're going to pay in $100,000 a year into this policy. Here's the thing. It's owned by the church. They still have access to it. Even day one, they've got access to $80,000 of the $100,000. But you can see, again, let's skip to year 10. They paid in $1 million, and in green, you can see the cash value there, just over 1.1 million, and the death benefit's 3.8. But let's get to the meat of it. What happens when he retires? So this pastor is going to retire at age 65, which if you're a pastor watching, I know you know no pastor retires at age 65, but let's be conservative. So let's say they retire. We got $2.2 million in cash value. The death benefit's up to $4.5 million. And we want to pay him a retirement salary of $75,000 a year for as long as he lives. So what happens if he lives till 70, 80, 90, 100, 110, 120? Here's what happens. The church gets repaid back in full and some however long he lives. But let's pick a number. Let's say he lives till age 95. So 30 years of retirement income. That's $2.25 million in retirement salary, which is pretty generous. What happens? The church will have outlaid $1.7 million total. The retirement salary, like I said, is $2.25 million to the pastor, and is $5 million paid back to the church. So again, I'll just recap that. Church pays 1.7, pastor receives 2.25, church gets back $5 million. They managed to triple their money while providing a generous retirement salary. The really cool thing about this is this strategy was designed by the Presbyterian Church. Whole life insurance was created by the church to take care of pastors' families. So this is literally an example of using whole life for what it was originally intended to do. Okay, what's the next steps? We say working with Unbridled Wealth, there's 3 steps: education, consultation, implementation. So on the education side, we want you to go out and continue reading, continue researching. If you don't believe what I'm saying, go and ask questions. But I forewarn you, if you Google, is whole life insurance a good idea? You're going to get a lot of opinions that are saying buy term, invest the difference, and explaining why this is bad. I guarantee you they're not talking about policies designed in this way. So read and study. We have recommendations if you'd like to hear them. Consultation. Okay, meet with a wealth advisor. It's free. There's no charge to this consultation. We're going to answer any questions you have. We can look at your strategy or your situation, and we want to define where you are today, where you want to be, and create a plan for you to get there. And then finally, application. So we're going to create a plan, and we're going to ask you to implement it. Stick with it and review it. So if you become a client of Unbridled Wealth, it's not a one and done, you purchase a product and you sail off into the sunset. We want an ongoing relationship with you where we can walk alongside of you. So thank you for tuning in. I hope this was valuable to you. And again, reach out to one of our wealth advisors and come in for a consultation.